How many people realized that within a few short hours, hundreds of billions in value could vanish and return? If you looked away at that moment, you may have missed a critical signal. This is not sensational drama. This is a market warning. Great investors watch these moments quietly because chaos reveals future money flows. When a key defense sector drops sharply, then rebounds almost immediately. This is not normal volatility. It signals deep forces at work. What matters is not social media noise, but the market chain reaction. Billions disappeared within hours, then just as fast returned. To impatient eyes, this looks like chaos. To experienced observers, it looks like preparation. Large money begins repositioning while headlines distract the crowd. This reflects a core Buffett principle. Ignore noise, focus on long-term drivers. Beneath short-term waves, a massive defense budget shift may be forming. $500 to $600 billion may be redirected quietly. Most retail investors do not see this yet. They react too late. The biggest mistake in such moments is emotional reaction. Buying in fear or selling in panic often creates the worst outcomes. Discipline matters most. Understanding context changes everything. This could be an early cycle stage. The shock was not empty words. It was policy direction. Public criticism questioned contractor efficiency and shareholder priorities. That alone shook short-term confidence. Markets respond fast to uncertainty, but the deeper change followed. New restrictions appeared, limits on dividends and buybacks, caps on executive compensation. This created a fog of uncertainty, and markets hate fog. Major defense names sold off sharply. Billions vanished again. Yet, from a long view, this was not punishment alone. It forced future cash flow toward real production and delivery. Then the narrative flipped quickly. Budget expansion entered the discussion. Compare that number to current spending. The increase is massive. Market expectations shifted instantly. Prices adjusted upward. Stocks not only recovered, they pushed higher. To outsiders, this seems confusing. To patient investors, it is logical. Short-term markets vote. Long-term markets weigh. The real insight lies in behavior. Institutions move differently, while individuals panicked. Large investors reassessed quietly. Policy shocks, misunderstood stories, and extreme volatility are where great fortunes form. For the prepared mind, listening is not about quick action. It is about seeing structure. This year demands attention, not passive following. Those who pause and reflect gain a lasting advantage. When observing market reactions, what matters is hidden money flow. Opportunities rarely look attractive. They often appear frightening. Sharp price drops scare most investors, but calm eyes see deeper. Do not watch red candles. Watch who is buying. Institutional capital reveals truth beyond headlines and noise. During extreme volatility, unusual trades often appear. These positions are not random. They reflect calculated conviction. Large option bets signal confidence, not vague speculation. Profit comes from probability and precise timing. The story extends beyond one company or a single trading day. When an entire sector shows strength, a larger picture is forming. Markets do not react to words. They react to money. Money moves before official narratives. Always ahead of confirmation, massive defense spending reshapes industries. Far beyond simple budget numbers, such spending leaves financial footprints across the entire system. Funding gaps often require borrowing. Borrowing expands money supply. More liquidity enters the system, and liquidity seeks assets. Equities become natural destinations for expanding capital. Markets do not wait for completion. They position early. That positioning starts quietly, long before public consensus. When strategic priorities become visible, capital direction becomes clear. Large defense programs create long chains, contract suppliers and beneficiaries. firms at the center gain attention from long-term capital. Not because they are perfect, but because timing aligns. Volatility frightens most participants, but informs prepared investors, watching contracts and policy matters more than reacting to prices. Timely information prevents delayed reactions and emotional decisions. In fast-changing environments, clarity becomes an advantage. This story goes beyond one project or a single industry. It reflects rising security spending across multiple strategic areas. Each decision triggers ripple effects through connected sectors. Understanding these movements calmly separates strategy from emotion. Looking broadly, what unfolds is not isolated. It is not a temporary idea. Shipbuilders, including firms from Asia, benefit similarly. They share forces driving the defense sector. This confirms a system-wide acceleration cycle, not a bet on one project. When industries expand forcefully, focus must shift toward companies at the center of flow before turning to lesser-mentioned names. At the center stands the largest defense contractor, a firm positioned to benefit most from expanding defense policy momentum. Many believe new defense technology firms will quickly replace established giants. That logic sounds reasonable at first, yet it misreads industry reality. Young firms can grow very fast. Some have clearly proven that, but defense is not such a field. Building fighter aircraft and bombers, missile systems and naval vessels, large-scale defense infrastructure requires decades of experience, factory networks, and skilled labor. Most importantly, regulatory trust. These cannot be built quickly. Therefore, traditional contractors will still receive the majority of new capital flows. Looking at what this company produces, the picture becomes very clear. Core platforms of modern military power, advanced fighters, missile defense systems, complex combat and electronic systems all sit within their portfolio. Public ambition to lead major initiatives further strengthens long-term strategic standing. Financials reflect the same reality. Annual revenue is already very large, but backlog far exceeds one-year sales. This secures revenue for many years. Delivery volumes set new records, showing acceleration, not slowdown. Major contracts continue to be signed. Follow-on funding often appears later. That is the defense industry nature. Initial wins unlock multi-year funding streams. The interesting part is market behavior. While other defense stocks surge strongly, this stock mostly moves sideways. Short-term thinking finds that unattractive. Value investors see familiar setups. In rising industries, lagging leaders matter. Strong foundations create asymmetric opportunity. Prices move in a steady rhythm. Breakout, pullback, accumulation, then advance. Volume patterns reveal quiet institutional buying, trading at a discount to peers, despite leading strategic position, draws attention from long-term investors. The biggest debate concerns buybacks and dividends. Limiting them upsets shareholders short-term. But deeper logic forces reinvestment. Reinvestment expands production capacity. Greater capacity raises output levels. Over time, higher revenue lifts value. This approach lacks instant gratification, yet matches intrinsic value philosophy over financial engineering tactics. Still, risks must not be ignored. Policy and budgets require legislative approval. Proposed figures can change materially. Buyback limits may reduce investor appeal. For those seeking steady cash flow, seeing both opportunity and risk clearly is how great investors stay grounded. Geopolitical tensions continue to rise globally. The environment looks very different today. Military modernization is no longer symbolic. Large commitments rarely stop at words. Defense spending is being pushed higher. Hundreds of billions may enter the system. This signals a structural policy shift, not a short-term political gesture. Even ambitious shield projects face uncertainty. They may fail, delay, or expand over time. Yet they reveal expanding defense priorities. Capital flows toward national security grow. Backlogs at contractors are already massive. Some key firms remain modestly valued. That contrast deserves careful reflection. Alongside legacy contractors, new names emerge. Some remain underappreciated by markets. Palantir stands as a clear example. The company delivered exceptional performance recently. Strong gains do not end the story. Markets often extend trends beyond expectations. Not forever, but probabilities still favor continuation. Understanding the current phase matters most. Is this consolidation or real deterioration? Palantir now shows uneven accumulation behavior. Key technical zones require close observation. Missing short-term data changes little. The structure resembles pause, not distribution. A decisive breakout remains the main signal. If price clears recent highs convincingly, another upward leg gains justification. Even with valuations already elevated, the logic rests on future spending allocation. Where will new defense budgets actually flow? Not toward outdated military structures. The world has clearly moved beyond that. Modern defense favors automated systems. Autonomous drones and unmanned vessels dominate. Missile defense and command networks expand. Artificial intelligence links every component. Humans supervise within massive data systems. Software becomes the true operational core. Platforms coordinating decisions gain importance. Within that ecosystem, Palantir stands central. It functions as operational infrastructure. Data analysis and execution converge there. Such positioning supports steady government revenue. Income builds gradually over long periods. This explains lasting structural appeal. Historical cases illustrate this dynamic clearly. Aligned fundamentals reward patient ownership. Long-term theses unfold naturally over time. This is not forecasting future prices. It reflects logical outcomes of sound structure. Risks must always be acknowledged openly. Budgets can be revised or reduced. Major projects may face delays. Buyback and dividend limits pressure shares. Short-term reactions can be uncomfortable. Yet, technological capability has progressed greatly. Large-scale defense systems are now feasible. Challenges exist, but execution is realistic. Past inefficiencies are being addressed gradually. Contract incentives appear to be improving. Long-term productivity may benefit. The final question remains very simple. Will military spending rise or fall ahead? Answering that clarifies portfolio positioning. If higher defense exposure makes sense, if lower caution is equally valid, opportunity lies beyond surface headlines. Understanding capital flows reveals deeper truth.